Good morning, ladies and gentlemen. Well, the risk dial still at its strongest in the 80s, whether it's 81 or 88 like it was the whole of last week. Neither here nor there, but it just still shows you that equities are the strongest asset class and will probably continue to be so. We're now entering a period of 2 weeks ahead of Jackson Hole. We've had probably one of the last important numbers, i.e. the NFP, which was strong. We are going to get inflation CPIs before we get the Jackson Hole conference from around the 24th, 27th of August. And basically the market is in preparation mode for the possibility of a more hawkish period from the Fed. We'll now examine what the yield curve is saying and what is most likely to happen in these 2 weeks of preparation. I would contend that trading the yield curve over the next couple of weeks is going to be very difficult. The main reason being is that the sector which is going to suffer most from some sort of Fed hawkish tilt and earlier possibility of tightening is going to be the 2 years and the euro dollars in general. On the other hand, the outcome might be completely different. So the position in the yield curve, I think, is going to be unwound. People are not going to be willing to have large positions in the yield curve. 2s, 10s have come back all the way to where they were at the beginning of the year. This is where we started the year, and this is exactly where we are now, within 1 or 2 basis points. Very, very good support around this 100 level. I doubt it's going to be cracked anytime soon, simply because people are not going to be willing to assume positions at very extreme levels. It's more likely that you get parallel shifts in the yield curve, as people have no idea what the Fed's going to come up with. So, I really wouldn't want to be very short of the yield curve below, say, below the 90s, but 2s, 10s are going to be all over the shop. So really not much is going to be learned from the day-to-day price of the yield curve, simply because people are not going to be willing to assume positions. More is going to be learned from the 5s, 30s and the 10s, 30s. What happened last week in the 5s, 30s? Well, nothing. This is the weekly chart. On a weekly basis, we were 1 or 2 basis points away. I think the odds of us breaking 105 in the next 2 weeks, 2.5 weeks, are very, very low, almost zero. As we can see on Friday, we actually steepened. What's that? 116, 1.5, 2 basis points. Unlikely that we are going to get much of a movement. I would be interested to see a movement below 125. That would tell me something. That would tell me that people are getting more bearish in bondland. But this is the one that I've been looking at, because this one is the one that would suggest to me that people are getting more afraid of inflation. If we now start breaking down towards 80 basis points in the 10s, 30s, that would suggest that people are getting more afraid of inflation. But I don't think that is likely to happen, simply because if the Fed does tilt hawkish, that is definitely a flattening trade. Whatever anyone tells you, the end of taper is a flattening period. The market has anticipated it. As you can see, this is the anticipation of taper. The fact of taper is probably only going to get us up to minus 56 or something like that. Breaking above minus 56 would be very, very significant. but I don't expect that to happen until after Jackson Hole and facts and real knowledge that the market has about Fed intentions. As I said earlier, twos and fives are likely to be the sectors of the yield curve which are most susceptible to a change in policy and an announcement. But until then, I think the fives are likely to top out somewhere around this 85 area. So I would not be surprised if in 2 weeks' time we're trading somewhere between 79 and 85 basis points yield. This kind of level as we did here, and we just trade up and down with more or less parallel shifts in the yield curve. Tens, slightly less susceptible to bad news, but we are basically looking for movements up to 139 basis points and then possibly up to 151 basis points over the course of the next 2 weeks. I don't think bonds can be strong over the course of the next 2 weeks, especially the short end, because all the dangers are that the Fed announces something which brings forward the calendar that we have at the moment, which is roughly that there will be no rate hikes. Tapering, yes, but no rate hikes. And I don't think it really makes any difference whether we taper straight away after Jackson Hole or we give it another couple of months. What difference could that possibly make to the bond market? Really, I mean, if you're trading 10s and 30s, 2 months here or there, what does it matter? What really matters is when we start the rate hikes and if the market even expects the rate hikes. So really, whether that is the second half of 2022 or the first half of 2023 is going to be important, especially for the very short end. The twos and the euro dollars especially. And the short end of the euro dollars, anything between September 2022 all the way out to March 2023, is no way is it going to be bid over the course of the next 2 weeks. There's going to be too much fear and too many banks who need to reposition their portfolio. If we look at what happened to 30s, the more significant one is here that we really could not sustain this 148.90 level in the TLT. More likely to come down towards 144, 143, and that would give us this 200-day moving average around 2 to 205 in the 30-year note. So those are the levels that I'm looking for, more or less parallel shifts in the yield curve, but more fear in the short end, as if we get hawkish figures for inflation, that is going to make people afraid that the calendar of rate hikes is going to be brought forward, and that is going to be very bad for euro dollars, anything from Sep 22 out to March 23. In Europe, the situation is slightly different. The ECB is much more dovish than the Fed, and that is being reflected in the spread between bonds and the 10-year note. As you can see, we've just broken on Friday this very important and pivotal 174 odd level. Where are we likely to go? I would suggest that over the course of the next 2 weeks, we will see this 180, 181 basis points, maybe even 182 or 183. But I would not expect us to be in 2 weeks' time to be a million miles away from 180. I would have thought that is going to be about as bad as it gets over the next couple of weeks. And if we look at what the German curve is telling us, here we have the bubble. I would have thought the bubble is likely to, I could never understand what it was doing down here. It's finally reversed, seen sense. And really, I would expect it for Jackson Hole, I would expect it to be around here. which is minus 68 basis points. You can see how important that level has been throughout the last couple of years. Minus 68 in the 5-year note is in the bubble is what I'm expecting. And if we look at the Bund, the equivalent level is very clear. It's around here, minus 36. That is the kind of level I'm looking for. So slightly bearish of both bubble and Bund. If we look at the OAT, I would have thought that it's clear that it can easily trade up to this zero level, and that would be a nice, I mean, all it's done, it's come down, filled this gap, and boom, you know, where we could be at zero and trading around zero in the next couple of weeks without any problem. The Italian bond, it can easily come up to these kind of levels, minus, you know, in the around around plus 70. I would have thought that is as good as you're going to get out of Italy, because really the curve between Italy and Germany is so unmoved. Sorry, the spread rather than the curve. It really is doing nothing around this 105 area. Can it get a little bit worse? Sure, but it really, I don't think it goes anywhere through 120. Italian bonds are still being bought because it's the only thing with yield. And the ECB is basically so dovish that I don't think the Italian bonds are going to underperform significantly. But I do think there's going to be pressure on the whole curve and individual tenures in both US and in Europe. Less so in Europe. Probably the most obvious position to have is to be short of bonds in the States and long of them in Europe. I think the odds, Europe is going to be a long way behind the Fed, whatever the Fed does. Given that I expect the differentials between the States and Europe to go out, really, I cannot really be looking for a period of dollar weakness at the moment. You can see how it's all basically turning for, I mean, it's got a move into the 93s and then 94s written all over it. If we enlarge this slightly, very likely to at some stage test the top of the Bollinger Bands, and that could take it all the way into the 94s without any problem. On the if we look on the dailies, that is probably clearer to see. We really need to break above 93.63 to get the next wave up towards the 94.50 level. But definitely the pressure is going to be on the dollar to go higher. You can see all this series of highs here around 93.63 or just slightly higher, very likely to test them. And as I've been saying for a couple of weeks, we are likely to try and touch this 115.34 to 114.35 level, you know, just where the 200-day moving average is, before any kind of really important announcement. The market likes to be close to some significant moving average. And, you know, I think the pressure is going to be on. I would be surprised if in the next couple of weeks we don't at least touch this kind of 115, just below 116 level. Well, a little bit of pressure in the bonds, not much though, was it? And a little bit of upward pressure in the dollar. And gold fell apart. Basically, the situation has not changed. I really cannot understand why anybody would want to be long of it here. Okay, this is 118.30 up to 118.40 is the area that has been resistance for now 1, 2, 3, 4 weeks without any problems, and that's exactly the levels that I've been marking down as what gold needs to break to be in the slightest bit bullish. It keeps on failing, i.e. path of least resistance down. On Friday, this is the daily chart here, we can enlarge that one. It basically, as soon as we couldn't break above the 200-day moving average in that area, we got down straight to 1,764, which is a really important level. And most importantly, we didn't bounce at all, right? I mean, we are through the Bollinger Bands. I bought some at, it's 62, 63, sold them straight back out because I saw this was going nowhere. Really, we are likely to break this level and slowly come down. At some stage before Jackson Hole, I would be really surprised if we don't touch the 1710 kind of area here in gold. I've been wrong. Gold is not moving to the center of the butterfly. Gold is still as weak as the bonds are, and is basically at the mercy of both bonds and the dollar. And that relationship can best be seen here. This is SPY over GLD, new highs. When a market makes new highs ahead of Fed, it just indicates that there is no fear of holding equities over gold. And here we have it against TLT, and we are coming back to test this 2162 level. I think it's going to hold. But it just shows you that it's basically married, and it's even weaker than TLT, and it's so much weaker than SPY. Basically, the chart is saying you can forget about gold against equities, and even against bonds. It's not very strong. It's not relatively strong. So holding gold at the moment seems to be utterly pointless. DBC is doing much better than gold. If you want to have some money in precious metals stroke commodities, much better to have it in commodities than precious metals. This is SPY over DBC. You saw gold making new all-time highs. Are we making new all-time highs? No, we're just trading nicely in a channel, and more likely to faff around in this channel than not. And on a weekly DBC chart, you can see that we are still above, although last week was weak. You would expect it when the dollar goes up, when the bonds are slightly weaker and higher in yield. Commodities really aren't doing very much, but even with all the weakness that we had in oil and copper and so on, we are still above this 1868 to 1841 very pivotal area. It's just on a relative basis a much safer, much less painful way of holding some what people think are inflation hedges. I would have thought that we were not going to be a million miles away here in the next couple of weeks before Fed. And if the Fed does nothing, or tilts dovish again, or not hawkish enough as the market expects, I would have thought DBC would perform on the upside much better than gold. I want to start the equity review with EEM because I think over the next couple of weeks, EEM is going to tell us relatively how equities in general are going to perform. If we are looking for a period of slightly higher bond rates and slightly stronger dollar, weaker gold. You are, the one that's going to catch it in the neck most is going to be EM. These are very unfavorable conditions for EM. What is EM doing? EM is basically just hugging the bottom of this Bollinger Band on the weeklies. And this is, to me, indicating that EM is going to be to remain weakish over the course of the next couple of weeks. It could easily be that we have an ABC pattern which targets somewhere around this 48 area, which I think is going to be a wonderful buy. So if we look also at the EM spreads, it's telling us several things. This is against Japan. As you can see against Japan, it's that they seem to be very married, joined at the hip. Basically, as EM does, Japan does not do much better or much worse. And the trend against Europe is also very unlikely to be, we have a very major level here at 107. I would have thought there's going to be a lot of support there. So really only if EM has a mare, has Japan, has Europe, and has the US, which really is the best one. You can see, and I said a couple of weeks ago, as soon as we broke this, that we're likely to go further. So it just shows you that EM is the one that's most vulnerable, followed by Japan, followed by Europe, followed by the US. Whether it's US or Europe who suffers more is neither here nor there. It's going to be, within fractions of a percent. But what I'm saying is that if EM does not get hit, then those markets can continue to do a little bit better. But we are talking very, very small percentages of outperformance in US and Europe. And we'll look at those next. 195-minute chart on the SPX could not really be clearer. We have a new level, 44.26, which was the previous high close. We broke through it, and late on Thursday and Friday, we just basically fuffed around in a very, very small range, still above it, still bullish. These Bollinger Bands are going to very, very slowly open up. So we are likely to trade between this 44.26 and 44.50 for at least, couple of days. Early next week, Monday and Tuesday. You can see how this is the daily. You can see how close to the upper Bollinger Bands are. We are 44.50, 44.60, and on the weeklies, the same thing. The upper Bollinger Band is going to be here, 44.70. Okay, so it's going up a little bit, but it just shows you that the upside, there's very, very little upside. And that ties in with what I've been saying about EM, that this upside that we potentially seeing here is actually just a little bit of outperformance to EM, and that's all there is to it. I really don't think that we're going to go a million miles away, and I really would not expect the SPX to be anywhere close to the top of the Bollinger Bands by the time we get to Jackson Hole. I would expect it to be much more towards the middle of significant moving averages, and say this moving average or even the 20-day or the 50-day. So somewhere around here, okay, we are going to be somewhere around over here, but I really would not expect this market to be a million miles away when Jackson Hole hits from here. I think the upside is very limited, but there is no downside. So basically being short of volatility is not wrong in the short term. And actually, I can show you an interesting chart. And if I can find it here, yeah, this is the position that I think is an interesting one, and that is short of volatility, which expires in 2 weeks, against longer volatility in September 21. And as you can see, the market is going down, indicating that over the course of the next couple of weeks, you're going to get, normal standards of volatility, but people are building in volatility after Jackson Hole. So I would have thought that this spread can easily, from, every time it goes up a little bit, I smack it into more negative territory. I think it's more likely to go down towards the -250, -300 area. You can see the trend is very clear. People are selling volatility in the next couple of weeks and buying volatility about what happens after Jackson Hole. I'm not going to hold it after Jackson Hole, but this seems to be a reasoned trade. There is reason behind this madness. If we're going to see any significant weakness in SPX, it has to come from NDX or tech. That's what I'm really saying. And this market just is relatively dead, it seems to me. We still closed above this 15,000 area, where we're slightly weaker, but you can see what the market is doing. Is basically going to range up and down. I really would be shocked if in the next couple of weeks we were much lower than this 14,575. So really the SPX can only be as weak as the NDX allows it. And we are really not seeing that much weakness in the spreads, and we'll look at the tech spreads next. Tech spreads, as you can see, XLF, XLK, this kind of level, 25, 26 is where we are likely to be in a couple of weeks' time. So really outperformance by the financials, and that can really be seen here in this chart of the Qs against IWM. I would have thought IWM is likely to be supported over the course of the next couple of weeks. How far down can we go? 160, 157. You're talking about 2 or 3 percentages. I'll just enlarge it so you can see the level, 158. But this is where we were, a couple of weeks ago, 3 weeks ago. It just basically says that we're not going to see very much overall movement in NDX, that the downside is going to be capped. And that really is going to keep the levels of SPX relatively constant. That SPX over the next couple of weeks is going to be doing relatively very little, and which makes sense to me. Sell volatility for the next couple of weeks and buy it after that happens, but certainly do not hold that position through Jackson Hole, because they will slam volatility wherever it is after Jackson Hole. I've been talking a lot about volatility, so let's see where it is. On a daily basis, you can basically see that it's bordered very nicely. 2005, 1558, what do you want to do? Very unlikely to remain below 1558 for any period of time. And as far as I can see, very unlikely to go over 2005 until and unless the Fed does something quite shocking. So that gives you an idea that the market is going to be very orderly over the next couple of weeks, that that the relative moves are going to be relatively small, and basically that market participants are just going to prepare themselves for whatever happens at Jackson Hole. they're going to lighten up positions, they're going to lighten up spreads. All this indicates to me that we have very small and reasoned movement in the yield curve, in every single tenure in the bonds, and in Europe, and relative in equities, unless the dollar goes up a hell of a lot and EM suffers. But I don't really expect that, because as I showed you, it's at the bottom of the Bollinger Bands of the weeklies. So relative movements are going to be compressed and they're going to be amortized. To me, anything below 15 is a buy in volatility. I really think that we are, for Jackson Hole, I will stick my head out and I will say that we will be somewhere around here. 1920 will be the price on the day, on the 2-3 days before Jackson Hole. So really, volatility another % down, and that's about it. But you can still keep the movements in the curve of volatility are going to be for a steeper curve after Jackson Hole, and then a flattening, say a month out of Jackson Hole. So this month, August, is going to be offered, then September is going to be bid, and November, December are going to be offered again. As far as Europe is concerned, exactly the same picture as the US. This is the UK, EWU. You can see that 34.10 level absolutely capped it. It hasn't been able to and will not be able to break it. These parallel lines in the DAX, and you can see where the upper Bollinger Band is. Very little upside in DAX. What is it, a couple of 100 points? And if we have a look at what is going on in the stocks against the DAX, you can see definite leadership in the stocks. The stocks are going up. The DAX is doing absolutely nothing. Relatively, the stocks is outperforming the DAX. Why is that happening? And I think it's because the relationship, if you remember earlier in the video and have a look, if you have a look at the stability of at low levels of the spread between Italian bonds and German bonds, that leads to a repricing of all these peripheral markets from the central market of Germany. These markets seem to be doing much better than Germany. So basically what it's saying, if you want to be long of Europe, rather be long of the peripheral markets than of DAX. And with that, onto the biases and the levels. I think the movements here are going to be relatively sedate. And also in Europe, I'm looking for further upside in yields, absolutely, but I'm looking for 4 or 5 basis points, 6 basis points. I'm not looking for 100 basis points. So that is what you're going to get. I think the equities are going to be at the mercy of NQ, and relative to EM, I think the movement is going to be very subdued. I have all the levels here. The DAX below 16 is definitely not a sell. Do not be short of it, even of the very front end. The danger is far too great. The Nikkei I didn't show to you, but it's still weak. It's still completely married to EM. The outperformance of Nikkei to EM is so slight that it's not worth thinking about. I'd rather think of Nikkei in terms of EM. It absolutely has to break 28,335 to have any chance of going higher and breaking away relative to EM. But it's very unlikely to happen, with the dollar being slightly stronger and slightly higher yields. I would have thought the next couple of weeks are going to be defensive in EM and Nikkei rather than not. Stocks leading DAX. been there for a couple of weeks, very clear that the stocks is leading DAX. Much better to be long of stocks than DAX. DXY looking for movements up to 93.14, and after that, it can do spikes beyond 93.14. And that is why EM I'm slightly defensive on, because if we get these spikes above 93.14, EM is not going to like it. DBC much better than gold. Gold, I would have thought at some stage goes down at least to 1710. Below that, it's going to be a very good buy because it will have discounted everything. But I would have thought, from 1765 to 1710, you sell a bounce into the 1780s and you look to cover down towards 1710. Thank you very much indeed. I think the next couple of weeks are going to be slow, thank God, but we'll try and do some relative trades and see where that leads us. Thank you, and I will tweet you on Monday.